All right, welcome to Chapter 13, where we're talking about taxation of corporate investment income. Now, the spirit of integration we introduced in an earlier chapter, where regardless of the source of income, at the end of the day, the person that is the end recipient would get the same amount after tax, whether it goes through a corporation or directly to the individual. So there's considerations given on the corporate level tax versus the individual level tax and credits associated for any taxes payable through the corporation. Again, just to recap what we covered in an earlier chapter, any eligible dividends have a 38% gross up with a federal tax credit of 6/11 of that said gross up, and any non-eligible dividends have a 15% gross up with a federal tax credit of 9/13 of that said gross up. And we talked a little bit again in Chapter 7, but specifically eligible dividends requires designation by the payer corporation. In general, as public corporations where dividends are eligible, there are some exceptions where there's a low rate income pool balance. And for Canadian controlled private corporations, in general, dividends are non-eligible, exception where there's a general rate income pool in place. Just a reminder, you may want to reflect on Chapter 7 as we go through some of this material. When the government created the gross up and taxable rates, there are some assumptions that they made for integration where the combined federal and provincial corporate tax rates under the eligible dividend situation is 27.5% versus non-eligible being a hair over 13%. For the provincial dividend tax credit, any eligible dividends get a 5/11 gross up versus non-eligible get a 4/13 of the gross up. So these are some of the initial assumptions made. Looking at some of the actual rates in effect for 2019, public companies who typically pay eligible dividends, they have a range of 25 to 31% corporate tax rate. However, generally close to 27.54% is required for a full integration. For Canadian controlled private corporations who pay non-eligible dividends, it typically is a low rate of 9, high of 15% corporate tax, with the larger range around 13.04%. And in general, across the country, the rates tend to be either too high or too low. So it's important to understand the province, and it's very dependent on which province in which the corporation operates to determine exactly how integrated the solution is. And actual dividend tax credits for non-eligible dividends in 2020, in order for integration, you need a 4/13 of the gross up being 30%. However, the tax range actual in place starts at 6% of the gross up on the low end to up to 36% of the gross up. And the average across the country is 21.5%. So the average is well below the required rate for a full integration. For the actual dividend tax credits, eligible dividends for 2020, in order for a full integration, you need a 5/11 of the gross up being 45.5%. Lowest across the country is 19.6, highest is 50.8, average overall is 36.8. So therefore most provinces, given on this average, are below the 45.5% to have full integration. Next we'll move into refundable taxes on investment income. So the definition for aggregate investment income that's used for this chapter, we include net taxable capital gains for the year reduced by any net capital loss carryovers. We include interest, rents, and royalties, but it excludes any dividends deductible in computing taxable income. So there's a slight difference compared to investment income in that taxable capital gains offset with capital loss carryovers. And just a reminder from Chapter 12 when we talked about adjusted aggregate investment income, which is different than aggregate investment income. Adjusted aggregate investment income also includes dividends from taxable Canadian corporations. It only includes capital gains and dispositions of assets not used in producing active business income, and there's no deduction in that case for net capital loss carryovers. We'll introduce the additional refundable Part 1 tax on investment income, where the amount payable is 10 2/3% of the lesser of two items, one being the corporation's aggregate investment income, or the second being the amount, if any, by which the corporation's taxable income exceeds the amount eligible for the small business deduction. By implementing this, it actually creates a total tax that's significantly over 50%, which we'll talk about in a moment. Rolling that forward about the refundable Part 1 tax, the problem is it creates an excessive tax rate on earning investment income through a CCPC compared to being an individual. So with the additional, aggregate investment income tax, the refundable Part 1, it includes or results in a tax at a federal rate of 38 2/3%. You add the provincial rates, which vary between 11.5 and 16. You get a total tax rate on investment income in the organization to be between 50 and 54%, which is typically well over what an individual would pay. What this does is it inspires individuals not to bury investment income through a corporation. A short example demonstrating the problem is, say there's $100,000 in investment income in the private corporation that pays a net tax of 54%. $54,000 in taxes would be paid. The resulting $46,000 net, if it's paid to the individual shareholder, without the solution we'll talk about in a moment, assuming they're at, say, a 41% tax bracket, would pay an additional $19,000 in taxes, resulting in a total tax paid on $100,000 of $73,000. The refundable Part 1 tax provides a solution to this situation, where if the corporate tax was lowered, the use of the corporation would provide deferral investment income. However, the better solution is to keep the corporate rates high, between 50 and 54%, and when a corporation distributes its after-tax income as dividends, part of that tax is refunded. The refund is equal to 38 1/3% of any dividends paid, and this high initial rate eliminates the possibility of deferral in most provinces. An example on how this works, if we look at the same situation where there's $100,000 of investment income in the corporation, at a tax rate of 54%, the balance before any refund would be $46,000 available. Assuming they're going to pay that dividend out, they would get the possible refund of 38 1/3% of that amount. So the $28,594 would be the refund, allowing a maximum dividend of $74,594. This reduces the overall tax rate in the corporation to an effective rate of 25.4%. So moving on to refundable Part 4 tax, there's a situation where a company might earn $100,000 of investment income in the company A. They would have paid $54,000 tax. But if they paid a dividend out to company B, they would receive a $28,594 refund, as per the earlier example, resulting in $74,594 being retained by company B. In that situation, it could be considered deferring tax on investment income. So, under this next section, Part 4, it creates a liability for refundable tax for private corporations and what we call subject corporations. So, any corporation that is not a private corporation that's a resident in Canada and controlled by or for the benefit of a specific individual or group. Also, they could be, for the purposes of Part 4 tax, they're treated as a private corporation for this component. In this situation, the refundable Part 4 tax is assessed at a rate of 38 1/3%, and it's refunded when dividends are paid at the same rate. This Part 4 refundable tax, a little more detail on page 649, 650, is applied when the dividends received from an unconnected company, or also apply when a dividend is received from a connected company, and that company paying the dividend received a dividend refund as a result of the payment through the tax methodology. Connected corporations are defined as those where there's a control greater than 50%, or where there's greater than 10% of voting and 10% of the fair market value of all issued shares are owned by that corporation. Continuing on the discussion around eligible dividends, any dividend that's designated as an eligible dividend qualifies for the 38% gross up, receiving a federal dividend tax credit of 6/11, as we talked about earlier, and this reduces the maximum federal rate on eligible dividends to 24.8%. And again, just to recap on non-eligible dividends, dividends that are designated as non-eligible qualify for a 15% gross up, tax credit of 9/13 of that said gross up, providing the maximum federal rate on non-eligible dividends to 27.6% approximately. Alright, the basic approach around dividends, whether they're eligible or ineligible, there's additional information on page 653 and 654. But in general, CCPCs, their income is eligible for the small business deduction, so it's assumed in most cases that they're non-eligible, not always the case. And but in the CCPCs, the investment income is eligible for a tax refund. Some exceptions are contained within the general rate income pool. For public companies, most income is taxed at general rates, so therefore we assume most dividends are eligible. and there are some exceptions in the low rate income pool. Looking at how we calculate the general rate income pool for CCPCs, we look at a number of items that get added or one subtraction, and that consists of the prior year general rate income pool value, adding 72% of the current year adjusted taxable income, adding any eligible dividends received in the year at 100% of the value of those said dividends, adding any adjustments for amalgamations or wind-ups, and then removing any eligible dividends paid during the preceding year. So in this situation, a designation by a CCPC can exist to the extent that there is a balance in the general rate income pool. Dividends can be designated as eligible instead of non-eligible. On the other side, we have non-CCPs and their low rate income pool. Similar calculation looks at the low rate income pool of the preceding year, adds in a number of items being the non-eligible dividends received in the year, any additions for corporate reorganizations, any adjustment if the CCPC, if it was a CCPC in part of the previous year, an adjustment if the credit union in some of the preceding year, an adjustment also if the investment company, if it was an investment company in part of the previous year, and then subtracting any non-eligible dividends paid during the year and subtracting any excess election made during the year. So in this case, they can designate a non-eligible dividend for a non-CCPC when a dividend is paid when there's a positive LRIP balance as per the previous formula. Otherwise, it should be non-eligible if there is a balance in their LRIP. If it's designated eligible, it'll be subject to tax on the excess designation. Now, if there's a situation, there's an excessive election where for a CCPC, the designation of that said dividend exceeds the general rate income pool, or for a public company where the designation leaves a positive low rate income pool, the excess is taxed at 20%. In some situations, the CRA might conclude that the excess deduction reflects an attempt to artificially manipulate either solution, and the tax rate could be as high as 30% on the entire dividend, not just the excess. An organization needs to keep track of what the refundable dividends tax on hands are. For 2019 and subsequent years, there are two different balances being for eligible or non-eligible refundable dividend tax on hand. There's no refund on eligible dividends if there's no balance in the eligible refundable dividend tax on hand. And in order to access any available refundable taxes, non-eligible dividends may have to be paid. It's important to understand that non-eligible dividends are taxed at higher rates than eligible dividends. Specifically, when looking at the eligible refundable dividend tax on hand, it starts with the opening balance, being December 31st for the previous year. It adds any Part 4 taxes on portfolio dividends. It also adds Part 4 taxes on eligible dividends received from connected companies, where the connected company received a refund from this said company's eligible refundable dividend tax on hand. And there's any deduction for dividends refund claimed from that in the previous years. Similarly, for the non-eligible refundable dividend tax on hand, it starts with the opening from the previous year, adds any refundable tax for the year, adds any tax on eligible dividends received from a connected company where they received a refund from their non-eligible RDTOH, and deducts any dividend refund claimed in the previous year. And one important difference on the two accounts is when dividends are designated as eligible, a refund can only be made to the amount that's in the eligible refundable dividend tax on hand account. Refunds can be provided on non-eligible dividends using either balance in the RDTOH accounts. Something that can also consider is the refundable portion of the Part 1 tax. The RDTOH definition, the limits increase to the least of three different Income Tax Act sections, being in 129(4)(a), 1, 2, 3. And it looks at investment income constraints, taxable income constraints, and the tax payable constraint, which we'll discuss in a moment. For the investment income constraint, it's determined by taking the 30 and 2/3% of the aggregate investment income less the amount, if any, by which the non-business foreign tax credit exceeds 8% of the foreign investment income. With the taxable income constraint, it's 30 and 2/3% of the amount, if any, by which taxable income exceeds the total of amount eligible for the small business deduction. 100 divided by 38 2/3% of the non-business foreign tax credit, or 4 times the business foreign tax credit. And lastly, under the tax business constraint, it's limited to the tax payable under Part 1. So to kind of recap as we go, the dividend refund for eligible dividends is equal to the lesser of 38 1/3% of the eligible dividends paid for a year, or the balance in the eligible RDTOH account at the end of the year. For the dividend refund on non-eligible dividends, component 1 and component 2, component 1 being the lesser of 38 1/3% of the non-eligible dividends paid during the year, or the balance of the non-eligible RDTOH. Component 2 is if there's an excess of 38 1/3% of non-eligible dividends paid over the balance of the non-eligible RDTOH, that component is the lesser of the amount of the excess, or any balance that remains in the eligible RDTOH after the refund on eligible dividends. There is some impact to these changes, where in any given year it might be difficult to use all of the RDTOH balance and yet maximizing eligible dividends. There's a little more detail on page 665 and paragraph 13-153 of the text. The next couple slides follow page 667 in the textbook. We'll start with paragraph 13-159, talking about a Canadian controlled private corporation, and 90% of the company's income is earned in a province, and the following information is available as per the next slide. They have Canadian source investment income of $100,000. They have a gross foreign investment income with a 15% withholding tax in that foreign country of $20,000. They have gross foreign business income of $10,000. They have active business income of $150,000 with no associated companies, and portfolio dividends received were $30,000 in the year, resulting in net income for tax purposes of $310,000. They removed the portfolio dividends received to $30,000 and removed net capital loss from the preceding year of $15,000, so they have taxable income of $265,000. Continue other data. Their eligible refundable dividend tax credit on hand January 1st, 2020 is $4,600. The non-eligible is $18,004. Their taxable dividends paid during 2020 are $60,000. Their GRIP as of January 1st is $12,000. Their taxable capital employed in Canada is $2.4 million, and their adjusted aggregate investment income for 2019 was $32,000. In this situation, there's no grind of the annual business limit because their employed capital was less than $10 million, and their adjusted aggregate investment income is less than $50,000. Their balances are indicated. Their GRIP is $12,000. Their eligible RDTOH is $4,600, and their non-eligible is $18,004. Their Part 1 tax payable would be a base amount of 38% of their taxable income, being $265,000, resulting in base 1 Part 1 tax of $100,700. Their federal tax abatement being 10% of the 90% in Canada, being $23,850. Their ART would be the lesser of 2 items, as calculated on screen, being $11,200. Again, details on page 667 and more. There's a foreign non-business tax credit of $3,000, a foreign business tax credit of $1,500, and then we have to continue to calculate their small business deduction. In order to calculate their small business deduction, it would equal 19% of the least of these 3 items. Their active business income being $150,000 as previously stated, their taxable income of $265,000 less their non-business foreign tax credit and their business foreign tax credits as indicated, for a total taxable income with those deductions of $248,286, and the annual business limit is $500,000. The least of those figures is the $150,000 of active business income, providing a small business deduction of 19% of that, being $28,500. Carrying that item forward, we now have to move on and calculate the general rate reduction. It would be calculated starting with their taxable income of $265,000, less the amount that was eligible for the small business deduction of $150,000, less the aggregate investment income, being $105,000 net, for a full rate taxable income of $10,000. They would get a general rate reduction of 13% of that, meaning they've reduced their tax payable by $1,300. Updating the Part 1 tax payable, then adding the general rate reduction at the bottom as indicated on screen, their Part 1 tax payable would then be $53,750. Now, carry on their Part 1 refundable tax credit would be 30 2/3% of their aggregate investment income, which is $105,000, resulting in a refundable tax of $32,200. Deduct the excess of their foreign non-business tax credit over the 8% of the foreign investment income, so 8% of the $20,000. So therefore, they paid a foreign non-business tax credit of $3,000 less the $1,600 overage, meaning they get a credit of $1,400 against the $32,200. Their total refundable tax in this situation under Section 129 would be $30,800. Carrying on the refundable calculation, we look at the taxable income of $265, take away the small business deduction of $150, apply the formula against their foreign component being $7,759 and their business foreign tax credit of $6,000. The total reductions against their taxable income for Part 4A2 of the refundable tax calculation would be $163,759, leaving a net taxable calculation against the $101,241. 30 2/3% of that would be a refundable portion of $31,047. And the last part is Section 3 would be $53,750, and the refundable portion of the Part 1 tax is equal to the least of these three preceding amounts, which if you recall was $30,800, $31,047, or $53,750. So the refundable portion is then $30,800. Carrying on to Part 4 refundable, on the $30,000 of portfolio dividends, they get a 38 1/3% credit worth $11,500. Their RDTOH balances, they're eligible at an opening of $4,600, and we add the $11,500 for the current year, so the December 31st, 2020 balance will be $16,100. They're non-eligible starting at $18,400 with a refundable tax of $30,800. Would leave a December 31st, 2020 balance of $49,200. The general rate income pool had an opening balance of $12,000. Adding their portfolio dividends received to $30,000 will leave a balance of $42,000. So for their dividend refund, then they have the full allocation of $60,000. $42,000 can be designated as eligible based on the previous screen, leaving $18,000 as non-eligible, the $60,000 less the $42,000 that can be eligible. The dividend refund on the eligible portion would be 38 1/3% of the $42,000 designated eligible dividend, which is $16,100, which is the ending balance in the eligible RDTOH. Therefore, that amount will be subtracted from the eligible RDTOH in 2020, resulting in a zero balance carry forward. Carrying on for the non-eligible piece, it would be the lesser of 38 1/3% of the $18,000 designated as non-eligible dividend, being $6,900. The ending balance in the non-eligible RDTOH was $49,200, and therefore the $6,900 would be subtracted from the non-eligible RDTOH in 2020. So, using all this preceding information, and again, lots of details in the book on page 667 to 669 for more details, they had a Part 1 tax payable of $53,750, Part 4 tax payable of $11,500, plus the dividend refund being two components, the $16,100 plus the $6,900, for a refund of $23,000. The federal tax payable in this situation would be $42,250. Alright, so as you work through large problems, there's a specific set of procedures that you want to follow. First of all, you want to do a reconciliation schedule to determine the net income for tax purposes, and then you'll determine taxable income. You would then calculate the basic tax payable at a 38%, and then a federal tax abatement. You will then determine the small business deduction for CCPCs. Continuing on, you would determine the aggregate investment income for CCPCs. You would determine the ART for CCPCs. You would determine the M&P profits deduction. You would then determine the general rate reduction, the foreign non-business income tax credit, the foreign business income tax credit, the Part 4 tax payable for CCPCs and other private corporations, the refundable portion of the Part 1 tax for CCPCs, then you would calculate the RDTOH balances, and then determine the dividend refund for those organizations. It's important to note the last few slides are walked through in text in additional detail on page 670, but once you've gone through the process and if you're very methodical about it, hopefully it seems to make sense. I will also suggest that in the real world you would have tax software that would actually walk you through the various components, but you need to understand what to look for and what to include. That ends Chapter 13. Thanks for listening.